central banks back in focus as always. Kenya surprising financial markets by raising borrowing costs to an almost 5-year high because of sustained inflationary pressure. Bonds gain. Governor Patrick Ngoroje, who's presided over his second final MPC meeting before his term ends in June, stated in a statement that the benchmark rate was raised from 8.75 to 9.5%. That was higher than the 25 basis point increase predicted by a median estimate of 6 analysts surveyed by Bloomberg. Since last year, there have been 4 increases. Joining us now from Nairobi to discuss further is Aly-Khan Satchu, who's the CEO of Rich Frontiers Management. Good afternoon to you. Thank you so much for joining us. What's your read of the interest rate decision by the Kenyan Central Bank? Were you one of the analysts who forecast 25 basis points and were you surprised by the outcome?
Actually, I was forecasting 100 basis points.
Oh.
So I think, So I think in this case, we'd already seen a significant shift in treasury bill rates and in bond rates over the last few weeks. There was a significant undersubscription of the 1-year T-bill. We've seen poor auctions in the rest of the curve. And I think the market was signaling that they expected the central bank to move more aggressively. And I think a 75 basis point increase signals some muscularity in the fight against inflation and situational awareness of what's happening in the bond market.
Okay, but how does that, I guess, so if the markets like what they have seen, do you then expect to see higher subscriptions with the next round of bids for treasury bills and other items in the money markets and fixed income space?
That's an interesting question. I think the central bank is going to have to do a little bit more and probably get up to double digits, but I think this was signaling the direction of travel. It is a major challenge at the moment because the Kenya government is relying entirely on the domestic bond market to raise funds, with the shuttering of the international bond markets for many African countries, not just Kenya. And therefore, they've got to signal a more robust inflation fight and a desire to bring inflation under control and thereby maintain the value of fixed income securities. So I expect a better performance, but I think more's got to be done in order to get that bond market performing in the way the government would like to see it.
If the Kenyan government is fixated on or overly dependent on the local bond market, as you said, what about the threat of crowding out the private sector? We're seeing the same thing here in Nigeria. Our debt management office overshot its target of borrowings by about 58%. So isn't there a worry of crowding out the private sector if the government is that heavily invested in raising funds from the bond market?
So absolutely, you're absolutely correct. This is part of the sovereign debt crisis that we've seen unfold across the continent in Nigeria and Kenya and in other places, which has meant governments have had to lean more heavily on local currency markets. That's put pressure on those markets. It's crowded out the private sector. It's also meant a lot of our banks are way too long in government securities, locally denominated government securities, and therefore also a steepening of the yield curve is causing mark-to-market losses on bond portfolios held by banks. In Kenya, banks hold about 300% of their capital in government securities, and I think this is a serious challenge and a weakness of the banking sector going forward. But to your main point about the private sector, this is a big issue. We've got the oxygen. There isn't enough oxygen for the private sector to thrive, and we've got to look at ways to get around the current conundrum. The way for Kenya to get around this conundrum is to lean more heavily on multilateral institutions. The president has been signaling and messaging these institutions very effectively. Latest trip was to Germany, speaking the language that these folks want to hear. And we need a significant upshift and the commitments that we've seen from these folks, I estimate it to be a $4 billion shortfall as we speak.
Wow. And in fact, your comment on the losses on mark-to-market, I mean, that's how SVB went down. I mean, based on what their losses in bonds. For Kenya, though, how are the macroeconomic variables around FX liquidity and other variables holding under the new administration?
So, this has been a significant challenge. Kenya historically has had a very open foreign exchange market, typically less than a shilling bid offer spread, and sufficient liquidity to change and move as much money as you wanted. For at least about 12 months, we've seen this situation unravel. We've had, an FX rate that the central bank has been quoting, which is basically one that you cannot transact at in the open market. There is a significant attempt now by the administration to address this issue. What they think, how they think they're going to address it is via this deferred oil purchase program, which defers the payment of oil for 6 months. If you calculate the cumulative total of 6 months of oil purchases, it's the single biggest expense item on our balance sheet. You're looking at probably about $2 to $2.5 billion. The question is that kicking the can down the road going to be sufficient, or does it have to be a permanent facility? I think it will probably end up being a permanent facility. I think it will then release pressure on the FX exchange rate, and hopefully we should move towards some kind of normalization. The negative spillover effects of this FX problem is that people don't want to invest in our stock market because they don't know what the exchange rate or if they will get the money when they want to sell. It means our bond market is significantly unattractive to foreign investors, and it basically throttles investment into Kenya, which historically has been an open economy.
You know, your analysis of the FX situation in Kenya mirrors exactly what's going on here in Nigeria. I want to step a little bit away from the markets, but I still want to see if this has an impact on it. The protests that we've seen called by Raila Odinga, any impact on the markets, or how are you viewing that development?
Well, obviously, at the ground level, there have been estimated losses of about 2 billion shillings every Monday when these protests have happened. That's just under $20 million. It's significant. It's material. And also, it's been a destabilizing element in terms of how people have viewed the economy. Whether these protests can last much longer is debatable. I don't think there is significant momentum behind them. As the American ambassador said yesterday, this was the freest and fairest election we've ever had in Kenya's history. And therefore, to dispute that election is not a sound basis of continuing these protests. What is a sound basis, obviously, is the cost of living crisis, which is worldwide at the moment, and that has traction. And so far, the government have not been able to bring down the cost of basic commodities. It's going to be a longer journey. There is no silver bullet. I think it takes 12 to 18 months, or a significant slowdown in the global economy, which reduces prices across the world. But at the moment, I think it's queered the pitch a little bit. There was a lot of positive momentum. Some of it has been stalled.
Can you give us a little overlay? Let's talk earnings from the latest from the equity group, and I guess what that means for the company going forward.
So yes, we've had all the banking stocks report their full year earnings. Equity Group, of course, is a tier one flagship banking stock here in Kenya under the mercurial leadership of Dr. James Mwangi. They've expanded, as you probably know, as far as DR Congo. They reported profit before tax up 15%. But this is a strong organic business. It's got a lot of potential. The challenge has been in that balance sheet is they've got a lot of government paper, not only Kenya shilling government paper, but also Eurobond, dollar-denominated government paper. and that slightly impaired the performance. I think going forward, however, we should see an improvement, and I think this is the penultimate growth stock. If you're looking at Kenya, they've got a fantastic banking model, they've got a very dynamic approach to the market, and I think you will continue to see strong growth out of Equity Group.
Okay, so my final question, just briefly, I guess if you were to pick a sector in the equity market for Kenya, would it be banking then? Is that where it wants to look at?
So the main sectors in Kenya, if you look at it, are banking, telecoms, which is Safaricom, or breweries, which is East African Breweries. But, those are single stocks in breweries, single stock in telecom. So banking, you have 10 or 11 stocks. So you have basically a broader smorgasbord of opportunity. So for investors, Safaricom has been very disappointing. It's practically halved in price from its highs last year. So investors are a bit wary about that. And I think part of the problem for Safaricom is that international investors want to get out because of the foreign exchange problem, and therefore are selling at practically any price. With the banking stocks, I think, yes, equity is the one I would look at, or maybe Stanbic as well, which is also looking quite muscular to me.
Excellent stuff. Mr. Aly-Khan Satchu, CEO, Rich Frontiers Management, thank you so much for giving us an in-depth lay of the land in Kenya's economy. Appreciate your time.